Chapter 11, we're going to start with dealing with annuities, and then we're going to move into kind of the basics of stocks and the basics of bonds, all of which are ways that we can invest. So an annuity is again going back to what we learned in our last chapter of compounding interest. It's a compounding interest computation, but now it involves the payment key. So we're still going to use our financial calculators just like we did in the last chapter, but now we're going to have a PMT maybe instead of a present value or a PV. So an example is if we save $1,000 every year into our IRA and we're earning 6% a year for 20 years, 20 is our N, 6 is our IY, nothing in our present value, so I zero that out. Now we have $1,000 as our payment, and then we compute the future value. So the calculator knows when I put it into the PMT field that this is going into that account every year for these 20 years. There's two different annuities. So there's an ordinary annuity and an annuity due. The calculator is going to come set to end, which is an ordinary annuity. So we're going to use that. So you should, the textbook does have some annuity due, but I don't believe I've assigned those at all. So you should be fine just sticking to how your calculator is. So what we'll get into in these ones, again, because we're dealing with payments, you're either putting money into like a savings account and you have a goal that you're saving towards, or you are taking money out. So if you're taking money out, you're making withdrawals, we're always computing for the present value because if we're making withdrawals from an account, we're taking money out of it. At the end, chances are we're going to have zero. So like say we're saving for retirement, or we're withdrawing for retirement. As we withdraw that money, we're going to use it up during our lifetime so that by the time we die, we're going to have zero left in that account. So here, if we think we need to withdraw $20,000 to, maintain our standard of living, and we estimate we're going to live for 25 years, and we've got it in an investment account earning 8%, how much do we need to have set aside the day we retire? Well, the day we retire is our present value of retirement. So we've got 25 years as our N, 8%, 8 is our IY. The payment again is 20,000. Now, sometimes I'll make that negative. You don't have to make that negative. In this case, you can just compute the present value, and your present value will be negative. Just don't put in the negative sign if you're entering it into your homework. So our amount going in is 20,000. There's no future value because remember, we're saving for our retirement years. There's nothing at the end. We're going to die. So we'll compute the present value. So we say, okay, the day we retire, we need $213,495 if we want to withdraw 20 grand a year. But then now we say, okay, well, we're not retired today, right? I'm still working. I've got 20 years left to save for retirement. So then now what I calculated as my present value of retirement, it now becomes my future value because I'm not there yet. So now I've got 20 years to save. I'm earning 8%. That retirement amount becomes my future value. I'm not starting with anything today, so I zero out the present value, and then I'm going to compute the payment. So I would need to save $4,665 a year to get to my goal. Now, businesses will have what they call sinking funds. So they have a specific goal that they want to have money-wise in so many years. So they'll give us what that goal is. That's their future value. They'll give us the time frame that they have to get there, and they'll give us the interest. And normally we're computing for the payment. In those sinking fund ones, the present value is normally going to be zero. They're not starting with anything today. They're going to set money aside monthly, quarterly, whatever, to get to their goal. Okay, so again, all of those we're going to use our financial calculators to compute. Then they get into talking about stocks. So stocks are a way that obviously people can invest money, and I'm sure you've heard of the stock fund and the changes in the values and when the stock fund drops and all that stuff. So this just kind of covers the basics of that. So they're going to give you like a table in the textbook and in your homework that you've got to be, excuse me, you got to be able to read that table. So one of the most important columns is going to be the closing price. That is what that share of stock is worth at the end of that business day. So if we were purchasing it, we would take our number of shares times the closing price plus commission. So the commission might be a certain dollar, like 50 cents per share or something like that. But we got to remember to add that to it. And that will be our total cost that we pay for the investment. The yield we need to calculate our annual dividend. And the dividend will, again, it'll probably tell us, again, that'll be a table. How much are you getting per share? So that's a dollar amount. And then if we divide that by our price per share, then we'll get what that yield is. What are we making as a percent per year on this stock? And then the price per earnings ratio is our price per share divided by our earnings per share. And they should also give us that earnings per share in the table. So you just have to be able to read the table and know how to use the numbers to calculate what they're asking us for. Now, if they give us mutual fund investments to say, hey, you're putting so much money in, then we'll go back to our time value of money keys and calculate the future value of that investment. It'll involve a payment, a PMT. Then the last section deals with bonds, and bonds are another way that investors can save. I'm sure you've heard of that in the bond. You invest in stocks and bonds. So bonds are different than stocks. Stocks, you own like a certain amount of the company when you own shares of stock. Bonds is you've loaned the company money. So bonds are sold in $1,000 increments, again, because you're not like buying like part of the ownership. You're actually loaning the company $1,000. So they set it kind of at a minimum. And it's just a way for a corporation to raise money. So instead of borrowing from the banks, they can borrow from investing communities, and their bonds could be put into bond funds, and they're getting $1,000 per bond. And then the bonds will pay interest. So what they'll do is during their lifetime, they're going to pay interest, and then at their maturity date, they'll pay the $1,000 back. So during the lifetime of the bond, we want to calculate what that interest is. So if we're looking at the bond table, which again is in the book, and they'll provide those to you, you want to look at what they say the coupon rate is. So the coupon rate is what they pay in interest. And then at the end of the maturity, if it goes for 10 years or 20 years, they'll pay back the $1,000. Now if you're looking at that bond table, the other thing you want to look at other than the coupon rate is the closing price. Now in the bonds, the closing price isn't a dollar amount, it's a percent. So what you do with that percent is you multiply it by the $1,000 increments. So be careful that when you're looking at that table, understand that closing price is a percent times $1,000, which is our par value. Again, the coupon rate is the interest rates that it's paying. The yield would be calculating out that interest and dividing it by what you paid. So again, what you pay is the $1,000 times that closing percent. And then, so then as we come down to this last one, you'll see at that closing percent, if it's below 100%, so say it says it closes at say it closes at 95, that would be 95% of $1,000. That's going to be selling at a discount. The purchase price is going to be less than that face value or that par value. Say you look at the table and it says it closes at 105. That's going to be 105% of the $1,000. So that's $1,050, and the purchase price is more than the face value. So we call that selling at a premium. So then here we have an example. Again, if we go to the bond table and say we're buying 25 bonds that have a $5 sales charge, and they're closing at 76.75. The bond table is not going to show you that percent. You got to know it's a percent. So it's just going to show you the 76.75, but then we know it's a percent. And the bond table is also going to show you the coupon is 7.75. It's not going to show you the percent. You got to know that. So then our cost is 25 times the 0.7675 times the $1,000 par value. So we're paying $19,187.50 to buy the bonds. Plus, we're going to pay a commission of $125. So that brings our total cost up to the $19,312.50. Then what's our annual interest? Again, $25 bonds times $1,000 par value times the 7.75% or 0.0775 if I turn it into a decimal. So my annual interest is $1,937.50. So if it asks for my effective rate, I take my annual interest and I divide it by my cost, and that effective rate is 10%. Now this, I don't know how much you'll have of this. You're going to have one like in your review assignment and one on your test. The textbook doesn't do a lot of these anymore, but this builds into what we do with bonds as you move forward in future classes, and it ties back to using our financial calculator. So when we have a bond computation, and if it asks us what would our current price of the bonds today be, and it gives us the details. So if we've got how many years to maturity, we've got what is it paying in interest, and then what is our face value, or I'm sorry, our future value is the face value. It's the $1,000 that they're going to pay back at the end of the bond. And then the IY, this is what is the fluctuating part. So the interest is always paid no matter what. The face value is always paid no matter what, and our maturity value is known. This is this market rate. The IY is the market rate. So it's what changes. So what else is happening in the market to change that rate, bring it up or down? And then we'll put all those into our calculator and compute the present value. And that will be the price to buy the bond today. So again, we're not tying back to the tables. We're saying based on what's happening in the market, this is the price I'm willing to pay for the bond. So if it's above $1,000, it'd be at a premium. If it's below $1,000, it would be at a discount. So again, you may have one of those on your test and your review. So come back to this slide to help you with that, because you won't necessarily see that in the textbook.